When two or more things collide, a disaster can result. And it doesn't matter if it's two storm fronts or a vehicle collision. When things collide, many times good things just don't happen. But in trading, the collision of two or more things can really be a blessing. Many times it can spell a difference between success or the failure of a trade. So now think of this. If many people are looking at X and then something happens at X, expect a reaction. If many people are looking at Y, expect a reaction. But what if X and Y, they meet and you get twice as many people looking at the same thing? Bigger reaction? Perhaps, but at least a greater chance of something happening. So to define a confluence, it's pretty simple. It's an act or a process of merging. When two or more variables are present, a confluence exists, and these areas are a good place to look for a trading opportunity. So let's take a look at this chart here, and we'll see if we can find a confluence of variables through technical analysis. Now, A is the top of the move, B is the bottom of the move. A simple fib retracement is drawn from point A to point B, and several levels are drawn on that chart. Number one is where price shot higher from, and that price level is obviously supporting price at that time. Price does eventually tumble through that level, although there's a little hesitation just below that. The red line represents a price area that once supported that price in the past. Number two is the 50% retracement level, which just happens to coincide exactly at that former support area. Now you can clearly see that price rallied from B right to that area. The moving average is pointing down. It's going to give you an objective trend direction to take a trade. Now how you enter a trade is up to you. It could be a range breakout or a trend line break. Perhaps you dialed down to a smaller time frame and you saw a candlestick pattern. Now the point is that a confluence of a former support level and a Fibonacci retracement area gave you an objective area in advance to look for a trade if price returned. Remember, support can sometimes turn into resistance. So let's take a look at the results. Line 1 is the bottom of the range of price A. A Fibonacci retracement is drawn from A to B, and it gives you areas to look for price to return to or to fall to. Price rallies to the 78.6 level, which is actually a great level due to where order blocks are found on the charts. And notice the huge drop after price hits that level. It's an exercise. Go through charts and just see how price reacts to that level. And the first chart gives you about 80 pips, and the second one over 200 pips. A confluence is a great thing to look for when going over your charts. It's a proactive exercise to pinpoint trading zones where if price returns to, that you can look at to take some action. Even better, it can force you to be more selective in your trades, which can really alleviate that disease of overtrading. Now, since we can enter the market using Confluence, what about exiting? There are also high probability areas where price can stall or reverse. And these are the areas you want to either exit at or lock in some profit. What you do is depend on your trade plan, the overall direction of the market, and your goals with the trade. The red arrow indicates the area that we looked for in advance of the price return to that area. Price breaks lower, but where do we exit? A is the low of the original move, while B is the completion. A simple Fibonacci retracement shows the 61.8 level lines up with a zone where price was rejected from. Look at the black line. That move down is about 70 pips from the bottom of the trade zone. Now you may have made more or less depending on how you enter that trade. The point though is a combination of Fibonacci and a support area gave you an objective area to exit. As an added point, that level also coincides with the 127% fib. So either the extension tool or the retracement tool gives you the same area. Now here we simply use the A, B, C move to give us Fibonacci expansion levels. And the red arrow is where the trade originates from. Line 1 has its zone at a level where price was once supported and lines up with the 100% extension area. If you're reading price action, there is really no reason to exit right at that level as price sliced right through it like butter. Line 2, that's the 127% level. But to the left, it just lines up with a cluster of trading activity, but neither a support or resistance level. Number 3, it lines up with the 161 level, plus it lines up with a support zone to the left. Although price did slice this level, it started to find some balance in that area. And here is either a great place to take some profits, all your profit, or just lock in profit. If you were in this trade, you may want to do some higher time frame analysis to see where you are in the bigger picture, considering that an uptrend is still intact, although it's weakening. Now, I don't know many traders who use one variable to find a trading opportunity. Even a simple pullback trade may need a confluence of factors such as strong momentum move to show strength in the market, a low volatility pullback into a zone of support or resistance, a candlestick reversal pattern to indicate the potential of a move in the previous direction. Now, I hope you can see how a confluence of factors, in this example using simple fibs and support and resistance zones, can give you objectivity in your trading when looking not only to enter your trades, but also to exit.